Currency markets can move dozens of pips in seconds, and often the trigger is a single number, the Consumer Price Index. The CPI is one of the most important economic releases on the Forex calendar. If you trade without understanding it, you are navigating with a blindfold on. So let's break it down clearly. The Consumer Price Index measures how much prices have changed for a typical basket of goods and services, things like groceries, rent, fuel, and healthcare. When that basket costs more than it did before, the CPI rises. When it costs less, it falls. Most major economies publish this data monthly. In the United States, that job belongs to the Bureau of Labor Statistics. When people talk about the inflation rate, they are usually referring to the percentage change in the CPI from one year to the same point the year before. A reading of 3% year on year means the average price level is 3% higher than 12 months ago. Now here is why traders care so much. Central banks, the Federal Reserve, the European Central Bank, the Bank of England, are tasked with keeping inflation close to a target, usually around 2%. When CPI comes in above or below that target, it signals that interest rates may need to change. Higher rates tend to attract foreign investment, which pushes a currency higher. Lower rates do the opposite. So, when a CPI number surprises the market, either higher or lower than what economists expected, currency pairs can move fast and hard. You will often see two figures reported side by side. Headline CPI includes everything, food and energy included. Core CPI strips those out because food and energy prices swing around a lot and can distort the picture. Experienced traders watch both. The comparison that really drives market reaction is the actual figure versus the consensus forecast, the average expectation from economists surveyed before the release. A higher than expected reading for the US can strengthen the dollar quickly. A miss can weaken it just as fast. A few things to watch out for. Initial reactions after a release are sometimes reversed within minutes once traders process the full report. Headline and core readings can tell conflicting stories, which creates whipsaws. And a single monthly number rarely tells you much. What matters more is whether inflation has been rising, peaking, or falling over several months. CPI data is most useful when you combine it with other indicators and with technical analysis. Used alone, it gives you half the picture. If you want to build comfort with how currency pairs behave around major data releases, practicing on a demo account at zenithfx.com lets you observe those moves in real time without putting real capital at risk. That kind of deliberate practice is how pattern recognition develops.